Hi guys. Today we will analyze D.R.Horton stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's performance in the overall market is below average. The long-term trend is still neutral, but the short-term trend is negative. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $69 and $65. Next strong support levels are around $60 and $52. Strong resistance levels are around $80 and $87. Next strong resistance levels are around $97 and $108. In the last month the stock has been trading between $72.50 and $80.40 range. It is currently trading near the lows of this range. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 18% per year, for last 5 years. We see that the average profit margin of the stock has been around 11% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 25% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for D.R.Horton Company: bad, average, and good. First scenario. D.R.Horton will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 5%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 20%. In this case, the fair value of the stock today would be $24. Second scenario. D.R.Horton will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 30%. In this case, the fair value of the stock today would be $40. Third scenario. D.R.Horton will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 7%. Future profit margin would be high, 14%. Future free cash flow to net income rate would be high, 40%. In this case, the fair value of the stock today would be $58. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 15.57. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For D.R.Horton, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 4. Again, I will use 3 different scenarios for D.R.Horton Company: bad, average, and good. First scenario. D.R.Horton will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 5%. Future P/E would be low, 4. In this case, the fair value of the stock today would be $41. Second scenario. D.R.Horton will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future P/E would be average, 5. In this case, the fair value of the stock today would be $56. Third scenario. D.R.Horton will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future PE would be high, 6. In this case, the fair value of the stock today would be $73. As you can see, today the stock is fairly valued, $72, if we expect the company's high performance in future. While the company has a great profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 7 to 8% yearly. Based on that, the stock looks a bit overpriced at the moment. The housing market is tricky, and it has elevated risks. The recent increase in interest rates is crimping housing demand. Do your due diligence before buying the stock. I may consider buying the stock when the stock drops below $65. Company's strengths. D.R.Horton is a home construction company. It's the largest home builder by volume in the U.S. It operates in 90 markets in 29 states. It operates 4 brands, D.R.Horton, Emerald Homes, Express Homes, and Freedom Homes. The U.S. housing market is undersupplied. This supply-demand imbalance will take years to address, and should support homebuilder pricing power. The company has a healthy backlog in sales orders. Large land holding also should help the company in increasing market share and topline. Horton has an edge in delivering affordable homes. More than half of the homes Horton delivered in the 12 months through June 30, 2022, sold for less than $350,000, and almost 3/4 for less than $400,000. While higher mortgage rates will strain affordability even further, Horton should be a dominant builder of affordable homes. Demand for entry-level housing should remain strong, as the millennial generation forms households. D.R.Horton's strategic relationship with publicly traded land developer Forestar, and its growing property rental businesses, should help fuel future growth. The company's return on assets of 19%, return on equity of 31% and profit margin of 17% are amongst the best returns of the industry. Risks. Home building is a very cyclical industry. It's also capital intensive, as builders often carry inventories of land needed to open future communities. Also, builders don't have the level of recurring revenue. Builders basically start communities from scratch, and have to find new buyers. Recession remains a short-term risk that could significantly impact Horton's business. High home prices, rising interest rates, and economic uncertainty could cause a meaningful slowdown in housing demand. The first-time buyers, who are so important to Horton, face the most pressure because they have lower incomes. They typically have less money to put down, and they are not selling a house that has appreciated in value. The company could be hurt if it does not have easy access to capital to finance its inventory of land, the ability to hire skilled craftsmen, the ability to provide mortgage financing, and to sell those loans to investors. Other risks include warranty claims, particularly if the company is found to have used faulty or unsafe materials. The company also could be vulnerable if home prices plunged and it had to offer major incentives to clear inventory. The company is involved in a range of litigation. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 7 to 8% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.